I'm Darius McDermott from Fund Calibre, and today I'm joined by Hugh Sergeant, who is manager of the elite-rated ES River and Mercantile UK Recovery Fund. Hi, Hugh. How are you doing?
Yeah, not too bad. Thanks very much, Darius.
Good, good. So I've known you for a long time, and you're a value manager or a manager with a strong valuation discipline. And we all know that value has really been out of favour for the last decade. Yet your fund is top quartile over 1, 5 and 10 years. How have you managed to achieve that with fairly strong headwind?
Thanks for that kind question, Darius. I mean, clearly it has been a tough few years for value managers. So I'm glad that we have managed to produce decent results over the last 10 years. I mean, perhaps just to confirm that we haven't done it by secretly being a growth manager. So if you look at our style skyline, we've always had a very clear value commitment. If you look at price to book, we've always traded cheap versus the benchmark. For example, today we're trading at about 1.3 times book value, the benchmark at 1.7, 1.8. So we've clearly been a committed value fund. If I could kind of break down why we've managed to generate reasonable returns into key components. I mean, the first is that our PVT philosophy, while it loves value, it's not just about value, it's potential, valuation and timing. Potential is looking for companies that can grow their shareholder value. Timing is thinking about when is the right time to put capital to work and looking for indicators. So we have a broader approach than just deep value. The second point I'd make is that we're multi-cap investors, so large, mid and small size companies, and definitely the SMIDs have supported our performance over the last few years. I think it helped that we didn't get too aggressive post the referendum when maybe other managers were getting more excited about the domestic opportunities. We actually said, this might take a while to pan out, so we're going to be relatively cautious. So we kind of stood back a little bit from getting aggressive. We did get aggressive though at the depth of the COVID crisis when opportunities were very significant. Additional point I'd make, and this is probably not kind of flavor of the month in terms of how managers should invest, but we have a really diversified approach to investing. Yeah. We allocate capital to lots of stocks, and we're pretty gradualist. And I think that approach has actually served us well over the last few years. So we take a 10 or 20 basis points initial position and then build up slowly as positive news flow comes through. And a result of that, we haven't had too many really difficult positions. So I think that gradualist, diversified approach has helped. And then add to that, we have had some individual good stock picks over the last year and over the last 5 to 10 years.
Well, let's focus in then on the last 6 months, because there has been a so-called vaccine rally, if you like, from the announcement of approval or not so much approval, but the fact that the vaccines worked, which came in early to mid-November. Your fund is up sort of around 30% since then, which is obviously very strong returns. Any observation as to which parts of the sort of market or which parts of your fund that have done well? And do you see that trend continuing out for the rest of the year?
Yeah, I mean, just by kind of way of background, explaining that strong performance, I put it down to a number of different aspects. I think the first, as you suggest, is the additional confidence about the economic recovery going out over the next year to 2 years, which came with the announcement of the vaccine news. A number of vaccines which were clearly efficacious equaled more confidence about the economic outlook, equals more support for our types of value recovery, multi-cap, and the kind of cyclical component that we had in the portfolio. So that was definitely positive. The second aspect was actually just, the starting valuation of the portfolio. So when your starting valuation is around 1x book value and your earnings yield is into double digits and your free cash flow yield is high, not that much has to go right for that portfolio to generate strong returns. An additional aspect is we've seen a slight change in direction over the last 6 months in terms of interest rates and bond yields, expectations moving upwards. That's kind of been in the news more significantly over the last week or two, this debate about reflation versus deflation. But anyway, those interest rates bottoming out has certainly been positive for the deep value part of the portfolio, the interest rate sensitives, banks in particular, which had been quite, had been laggards over many years, and even through the initial value recovery, they started to pick up. So that's been supportive. And the last aspect, I think everyone got so bearish a year ago, including analysts on individual companies. So they brought down their expectations really aggressively, and it's been relatively easy for our companies to beat really quite cautious expectations. So the underlying fundamentals of those stocks have been quite strong versus very low expectations. And then the follow-up question you had was just about, whether this kind of continue. And obviously the first observation, one has to be a little bit cautious and just say, nothing goes up in a straight line, either in absolute return perspective or relative return perspective. So we'd expect a period of consolidation. That said, all those different aspects that I just talked about, I think they're in play today, and they're likely to carry on being in play. So the economic outlook being relatively positive, interest rates trending positively, our portfolio being attractively valued in an often expensive world, and then the ability of our companies to continue to beat relatively modest expectations. So I think that's all in play still, which should allow us to continue to generate decent returns.
So let's pick on a stock then that maybe talks to exactly that sort of environment that you mentioned. I see that you've recently added Whitbread, which obviously is a pubs, but also owned of Premier Inn. So that's sort of a double UK recovery play or whatever. Is that a reflection of that sort of optimism in reopening, or is that a stock-specific example that is just so out of favour or so cheap? What's your view on that stock into that?
Yeah, no, Darius. Yeah, it's you're right. It's a bit of both. So I don't quite know why it's still called Whitbread because it's obviously its current focus is on the budget hotel area. In particular, it's very strong Premier brand. And as you suggest, clearly hotel operators around the world, particularly in the UK, have been hit by social distancing requirements, working from home, etc. So their occupancy has been really weak, has equaled a share price under significant pressure in the first half of last year, equaled an opportunity to buy into a company where the share price was depressed and where also valuations were very supportive, and where one can be reasonably comfortable with the medium-term outlook from here as a kind of vaccine, as you suggested, a vaccine play. So as economies around the world, hopefully led by the UK, given how well advanced we are with the vaccination rollout, as economies open up, room occupancy improves and their profitability will start to significantly improve. So it's a great recovery play with a strong name. Then the other aspect is that went into this this economic downturn with a very strong balance sheet. So it's in a position to invest. And actually, the other aspect of the business is ability to invest in Germany, which is its second market, where they're very underrepresented in terms of budget brands in Germany. So that's a growth opportunity. So you've got recovery in the UK and potential growth in Germany. So yeah, we like the stock a lot at the moment.
And can you talk to me maybe about one more stock that excites you at the moment in the fund? Doesn't have to be a new one, but something where you see some really good return opportunities.
Yeah, maybe just a couple in terms of kind of segmenting the portfolio. I mean, one part of the portfolio would be the traditional deep value part of the portfolio. In particular, the companies that benefit from interest rates actually trending positively. And in that camp, I would put the UK banks, and our favoured one is Lloyds. Very kind of out of favour, still very unloved, very cheap, 0.6 of tangible book value. But we actually see, the medium-term outlook as being reasonably robust in the context of interest rates moving up. That allows their margins to bottom out and start to improve. The credit cycle is much more benign than we might have thought a year ago. They're generating a lot of free capital, which over time will be able to be paid back to shareholders. So we like those dynamics of that traditional deep value stock. Lloyds, secondly, in kind of the classic recovery stock. So we've talked a little bit about Whitbread. Another one I like is Aston Martin. Which again, a kind of classic autos recovery. It's kind of brand that is particularly iconic, but as a business, it's never really made much money. But we do think the current management team are very impressive. We like the idea that they're going to build the brand by being on the grid for F1 this season, and if the new management manages to get that brand even stronger than it is already, we do think there'll be interesting recovery profile for Aston Martin. So that's
great. Thank you very much.
Idea.
Yeah, no, some really good ideas, and thanks for talking us through UK recovery, both in the name of the fund and obviously the value parts of the stock market. For more information on the ES River and Mercantile UK Recovery Fund, please visit fundcalibre.com.